What's going on, everyone? Welcome to another episode of The Remote Real Estate Investor. I'm Michael Albaum, and today I'm joined by Shawn Moore, who's the founder of Vodacy, a short-term and vacation rental education program. And he's going to be talking to us today about what we need to be aware of as we get involved in the space as investors. So let's get into it. Shawn Moore, what's going on, man? Thanks so much for hanging out with me today. I appreciate you.
Awesome, Michael. Thanks for having me, man. I'm really excited to chat with you.
No, likewise. So it's going to be a lot of fun. We are going to be talking all things short-term and vacation rental today, but I want to give our listeners a little bit of background into who you are, where you come from, and what is it that you're doing in real estate today.
Yeah, awesome. Well, first, thanks for having me. And yeah, we've been around the real estate game for a little while now. I've been a full-time real estate investor for 22 years, if you can believe it. I feel like I've been around the block a time or two and really started my journey into real estate in the fix and flip game for a long time. I was just doing mostly fix and flip houses. I wholesaled one deal. It's what got me into the game back in 2000. And then realized I wanted to start doing the actual rehab on the properties, and did that for a good bit of time. And I remember going back in the day to a real estate investment club, a local real estate investment club meeting, kind of sticking my chest out and acting like I was a big shot, and telling everybody how awesome I was I think I was about 23 at the time, and felt like I had arrived, right? And I remember this old guy named Georgie came to me and put his arm around me and just said, "Hey, Shawn, I know you think you're a pretty big deal around here, but you're really not a real estate investor. You need to quit referring to yourself as an investor. You have a job fixing up houses." And at the time, I really shot my ego, right? I was like, man, this kind of sucks. I mean, he's like, if you can't be an investor if you don't have any passive income. And that was back in I was a couple years into real estate, what I thought was investing, which a lot of us have done fix and flips. And but he was right. Really, I'd buy a house, I'd have to fix it up, and I'd sell it, and I have to keep doing it over and over and over again. And really, that's what I had. I had a job of fixing up houses and selling. So it opened my eyes back then, that conversation, to the idea of passive investments and passive income in real estate. And, there's lots of avenues, lots of lanes that you can run down in real estate. And the natural lane that I ran down at that time was single family rentals, and just buying some single family properties over a couple year period. This was back in the early 2000s. And if you could fog a mirror, you could get a mortgage. And so we were able to get a lot of mortgages really quick. We got about 52 properties in a period of a couple years, all single family homes. Wow. We had one fourplex. Everything else was single family or duplexes. And so we started building that passive income up. It just wasn't exciting for me. It was one of the biggest mistakes in 2005. We sold them all. And I always tell people, at the time I acted like I was a genius because we sold them right before the crash, but at kind of the top of the market, or close to the top of the market. But it was, obviously we were making, I think out of that entire portfolio, I was making about $3,000 a month in passive income. But on each of my flips, I was making, $30,000 to $50,000 depending on the flip that we had. And I was like, man, I can make, making a year's income with one flip versus having this whole portfolio that I was managing myself. And it was just kind of a pain, and really didn't figure the game out as far as how to actually make them passive. And so we ended up selling them all. That was probably the biggest mistake we ever made, because then we went back to not having any passive income, right? I had this portfolio that people were paying for. I was making money, not a lot of money, but I was making money every month. And ended up I got out of that game. But at that time, when we sold them, we started getting into the high-end resort properties. We started really diving into resort properties and second homes. And I'm talking like really high-end private ski golf resort properties, like in the $20 to $30 million range. And so not what we do now. And it was this really exclusive resort, but it introduced me to this new world of the hospitality world, the second home world, the resort type style properties, vacation home properties, right? And at that time, I had bought a cabin. My wife and I bought a cabin in 2006, and that was our first vacation rental that we ever bought. Well, in 2008, we started doing this in 2005, 2006. Well, in 2008, late of 2008, the FBI came in and shut down this resort that we were selling properties for, these really high-end resorts. The owners got indicted on securities charges. And so we literally just overnight, computers are gone. The resort we've got that we're involved in and selling properties at, all of a sudden it shut down. And we're like, what is going on, right? We stopped our fix and flip business. I didn't have any passive investments at the time because I sold them all. And I had this one property, this one vacation rental. I sat on my hands for about 6 months and threw myself a 6-month pity party and started to realize nobody was coming to save us. We didn't know what to do. This is in 2009 at this time, and the markets were tanking every day. The news is there's more foreclosures than there are. Every single day there's just worse and worse news. We're in the middle of the Great Recession, and I started selling real estate. I had a real estate license. I'd never done that in my life. As far as an actual residential sales agent, we started doing that. I started working with investors to help them build portfolios of, again, because I understood investors. I had been one, but I didn't have any money to invest at this stage, and really started getting back into just selling real estate and kind of hustling to pay the bills. And during this whole time, as I was throwing my 6-month pity party, we lost our house. I lost my vehicles. We literally lost everything because I sat there and blamed everybody and everything on my situation rather than doing something about it. And I had this one asset, this one property that during this entire slide was producing, and it was a vacation rental. And at the time, that was before they were really popular, right? That was, they weren't mainstream. They were obviously, Airbnb was around and VRBO was around, but they weren't as mainstream as they are right now. Mm-hmm. And I started to at least, those seeds were planted in my head that this might be a viable asset class to pay some bills, make some passive income, even during a pretty rough time of real estate, right? Even during that 8, 9, 10, that slide that we were in the middle of. And so as I started to build back up and get back involved in investing and developing properties again, my wife and I ended up having some kids, and we ended up having twins in 2011. And that kind of changes your perspective on everything. Instead of this really cocky, freewheeling, okay, I can just make money whenever I want and do whatever I want. My perspective on everything started to change. I started to ask different questions. I wanted to, you start to say, okay, what kind of an example can I be? What am I really building? What am I really doing things for? So you ask those different questions. And as they started growing up, I started to say, I loved real estate. I remember walking on the beach with my son, and they were 4. We were in Hawaii. We always go to Hawaii for their birthday. And I was frustrated. I was working on a deal. We were doing development deals at the time. And I was working on a deal, and I got off, and he could tell I was frustrated, and he's just a little kid. And he's like, Dad, you should just do real estate in Hawaii. It's way fun. Right. and so like that would solve all my problems. Right. Like, we're here in Hawaii. Why don't you just sell real estate here and do stuff here? Because you won't be frustrated on your phone calls. Right. That's the perspective of a 4-year-old. But what really got me thinking was, what do I love about real estate? And one, I love investment properties. I loved the idea of building passive investments and passive income from real estate. And I loved that resort style, that vacation style world that we were introduced to, even though it all came crashing down. And I had this one property, and I really started at that time forming this idea of what we do now with Odyssey, of really taking vacation rentals as a vehicle to build financial independence and wealth and financial and lifestyle freedom. And that's really when it started back in 2000. That was back in 2015. And then we fast forward to where we're at right now. We've got Odyssey as the number 1 vacation rental education company in the world now. And it's just been a lot of fun and a wild ride. So long-winded answer there for you, Michael, but that's kind of what brought us to where we're at.
I love it, Shawn. Well, as you mentioned, it seems that vacation rentals are the new it thing. Everyone's talking about them. You hear about them all the time. So curious, without giving away the farm, what do people need to do that's right? How do people knock it out of the park with vacation rentals? And then conversely, I want to ask, how do people really screw it up?
Yeah, great question. And really, there's really 3 phases that we focus on that I think are critical for people to get. And it's the acquisition phase. So really understanding the underwriting, really understanding there's a lot that goes into a good property and a good area, and really understanding, and they're harder to underwrite than what we're used to underwriting with a long-term rental, like, because you've got nightly rates that are fluctuating all the time. You've got occupancy that's fluctuating all the time. Most of these areas are very seasonal. And so you have to take in all of these factors that are moving targets and figure out how to compile that data to actually run the numbers, because you'll have really good properties and really bad properties in every area, even the best areas. You're going to have, not every property works even in the best areas. And so there's a lot that goes into that first phase of acquisition and really underwriting. And I would say in the beginning, that's where most people screw up. Most people think, hey, this is a great market. It's a vacation rental market that I like. There's, let's say Destin, Florida. Everybody's down in Destin, or Orlando, right? The kind of the home base for vacation rentals. Mm-hmm. That must be a good market because everybody's down there and I'm going to go buy down there. That's not how you underwrite these deals. And so the very first part is really where people mess up, is not understanding how to run the numbers. And it's not rocket science. It's just much different than what people are used to. And so that's the first phase that you really want to focus on and dial in. You've got to be able to underwrite and find the best markets and the best properties. And it's not always about finding the top vacation rental markets. Some of I call them backyard resort communities that maybe are unknown outside of a regional area can be some of the most productive, markets to invest in. We've got one of our members who's a traveling nurse, and he builds a portfolio around major medical centers. So there's all kinds of different markets that can work for short-term rentals. And it's not always these Class A resort towns that everybody thinks about. So really understanding, how do you analyze a market? How do you analyze properties within that market and what works? And that's that very first stage of that acquisition. And then the next stage is the setup and management phase. And where a lot of people dive into short-term rentals and they say, well, I'm going to manage this property on my own. And like, I can tell you, like, I have a portfolio. I don't manage any of my own properties. I know how to manage properties, but it can be a full-time job to manage your own properties. And unless you want a big side hustle, and you have the time for a side hustle, which a lot of investors, that's not what they're looking for, right? We're looking for passive investments. And so you really have to walk into it with your eyes wide open of what the management side looks like, and how do you build a management team so that it can become passive. And one, how much are you going to pay for it? Because it's going to be your largest expense. And so really diving into that second phase of that setup and management to really get the property set up correctly. And then that third is the marketing. And that the marketing side is, how are you going to stand out in these crowded markets, right? A lot of these markets, like you talked about, vacation rentals are kind of the it thing. They're kind of the trending the trending real estate investment, if you will, for a lot of people, because they think it's, the Wild West is, you make way more money on a short-term rental versus a long-term rental. That's not always the case. Again, going back to the underwriting of it. But when you dive into these markets, how are you going to get your unfair share of business? How are you going to stand out? Because these markets are crowded. These markets are getting very, very saturated. And I always tell people I really like saturated markets because it shows there's huge demand, but you better know how to stand out in a crowd, right? And it's not always what people think, and it's more how you set that property up. We always talk about delivering a unique experience. Like, right, a lot of people in real estate, because we're dealing with real estate, I always give an example of, if you have a Zillow listing and you have an Airbnb listing, they should look completely different. Yeah. And a lot of times they look the same. They'll use the same photos, like, right, they're selling the architecture and the property and the house on Airbnb, and that's not what you sell. You've got to sell the experience. You've got to sell what it's going to be like to use that property. And so that's what we really dive into. And that's by far and away the biggest mistake once people own properties, of what they're doing and how they go about this business, is not understanding how to articulate what they have to offer outside of just pictures of a house. Does that make sense?
Yeah. It makes total sense. And something that I always joke about, Shawn, I always say, you gotta have a high Instagrammability factor.
Yes.
In your short-term rental listing photos.
Yeah. And it's selling the experience, right? It's not we like Instagram because we can dive into people's worlds and we can see what they're doing. And we have to have that same thing with the properties. It's not just having property photos. I should be able to look at your listing and put myself in like mentally put myself in that setting and say, this is what it's going to be like to stay in Michael's home, because it's,
Right.
and it's always, and I talk about delivering the fairy tale, having, a unique story, giving that property a soul when you're really trying to articulate that to your prospective guest that's looking online, and it's actually, if you get that right, now all of a sudden you're playing in a category of one and you're really standing out in a marketplace, because nobody takes the time to do that. Everybody just goes and hires professional real estate photographers to take pictures of their property, but they're not doing anything to articulate the experience.
Right. So, Shawn, question for you. For everyone listening out there that's raising their hand, it's like, that's not me. I don't have that vision. I don't have that creativity. What should they be doing? Or should they not even be playing in the short-term rental space? Does that mean that it's not a good fit for them?
It's a great question. Now, one, you can definitely still play in the game. I think people think, because you can do a really good job of being, it doesn't have to be this in your face, like creative theme that you're putting together, but you do have to be able to put together an experience. And so it may not be the right fit, right? If you're just like, I talk to investors all the time that will say, hey, I just want to buy a short-term rental because it has better returns. I don't care where it's at. I don't care what it's doing. I just want the returns. And I always tell those investors, you're probably getting into the wrong game, because that's not what short-term rentals, that's not how you succeed with short-term rentals. So there is an element there, Michael, where you do have to say, I do want to provide a really fun, unique experience for somebody. I really do want somebody to come experience this area like I experience it. And I always tell people, you should buy in areas or around properties that will attract, that you're attracted to. You should be part of your target audience, because if you're not, you're going to fall flat when you're delivering that experience, when you're setting up an experience. I have a property that is a fly fishing property, and it's up by Yellowstone National Park. And I said, I love to fly fish. And so it's very easy for me to articulate what a great fly fishing experience is, because I understand that group, right? It would be very difficult for me to put together a wellness yoga studio for somebody, because I'm not in that group, right? But we have some of our members that do these amazing wellness retreats that are these beautiful properties, and they have these yoga studios and they do all this stuff but they know how to articulate to that group. And so there is definitely an element to that. And so if somebody says, I'm not that creative, I challenge people to say, you probably are. You want to set something up that you're attracted to. And if you're absolutely not attracted to anything and you're like, I really don't care, then it's probably not the game you want to play, because you're going to struggle when it comes to really maximizing the asset.
Yeah, that makes a ton of sense. And Shawn, you said something that I want to come back to, and it was with regard to the underwriting, kind of that first phase that you mentioned. In the long-term rental world, we have the 1% rule. So if something rents for about 1% of the purchase price, it'll probably cash flow with a mortgage. Yeah. And we have the 50% rule, which says take roughly 50% of the income, throw out the window to operating expenses. What's left over is to pay the mortgage and your cash flow. Do you have those similar types of rules, I'm going to say in quotes, to help people underwrite at a 30,000 foot level?
Yeah. And so the easiest, so I usually use a 10% rule. So you want to have about 10% of your acquisition price in gross annual income. So if you buy a $500,000 property, your break-even amount for your annual break-even amount, you need to generate about $50,000 in revenue. So
and is that with debt?
That's with debt and with management. And so that gives you, that'll give you about your break-even amount. Expenses are going to vary because you got one big variable expense in management, and your management's going to vary anywhere from roughly about 20 to 35%. And so that's a big of your gross revenue, right? So that's going to be your largest expense by far. And so usually your expenses to cover debt service and management is going to be somewhere around, it's usually around that 65-ish, 65%. So it's a little bit higher than like what you would find on long-term rental, but your break-even mark is it's an easier number to come up with, because usually the way we underwrite these, Michael, is we're looking for annual gross revenue, because your 1% rule is on a monthly basis on long-term rentals, right? The 1% rule. Well, our monthly income is inconsistent on these properties. So we have to look at an annual basis. A lot of these areas, you'll make 70 or 80% of your gross revenue in a 3-month span, right? So you're going to make it during the peak summer season, for example, in some areas. And so that 1% rule, you might be negative cash flow for 6 months out of the year, but you could be really profitable at the end of the year because your peak season made way more up than what you had to on those months that you were losing. So it's close to the 1% rule. That 10% rule is close to the 1% rule, but you have to annualize it because the way that we run the numbers is going to be on an annual basis because your monthly numbers are going to be fluctuating so much.
Makes total sense. And then you said about 65% on the expense ratio side of things.
Yeah. And so, the biggest jump in that is your management, because your fixed expenses are going to be very similar to a long-term rental, right? You got your principal, interest, taxes, insurance. You're going to have higher utilities typically because you're paying the utilities on the short-term rental side. So you're going to pay more of your utilities, and you're going to have a higher management cost than what you would on the long-term rental. Everything else is going to be pretty consistent as far as the other. So that's why it's a little bit higher.
Okay. That makes total sense. And should you be factoring in, this is your personal opinion, for cleaning fees? Is that part of your gross revenue, or is that same dollar in, same dollar out, so we're not even going to count it?
Yeah, it's a dollar in, dollar out. It's a pass-through expense, so we don't even count it. Now there are people that will run the numbers, they count it, and then they'll count it as revenue, but then they have it as an expense. We just cancel it out because it's a pass-through. We don't make money on cleaning. Some people do. And so if it's a revenue generator for you, you could add it in that way so that it's, $1 in or $2 in and $1.50 out, right? So you've got a little bit of a buffer there. Anything that's a pass-through expense, we just don't factor it in.
Okay. And that makes sense. Shawn, I'm seeing, and curious to get your thoughts if you're seeing the same thing, but these vacation rentals, these short-term rentals, as they're being sold and marketed, they're being marketed like a business. And they're saying, hey, based on the NOI performance, this is the value of the property. But as you and I know, to go get a single family rental or a single family mortgage, it's going to be based on the appraised value. So How are folks squaring those two things?
Yeah, it's a great question. And I think it's going to be a little while before I think that you've got a lot of sellers that are trying to value properties based on performance and based like a business, but you're not able to get lending that way, right? They're still for all intents and purposes, most of the lenders out there, you're still buying and getting residential, regular mortgages, second home, vacation home, investment property mortgages. It's going to be based on the property appraisal. Now, where sellers have been getting away with it a little bit because it's so competitive and most things are selling over appraisal. So people are paying an appraisal gap, right? We were seeing that even outside of the vacation rental space, right? People are paying over and paying that appraisal gap. So sellers on vacation rentals, that's how they're starting, or they have been pricing properties. And we've been used to multiple offers. We've been used to covering appraisal gaps. As things start to soften a little bit, I think that sellers are going to struggle to continue to price properties that way. I think that there's definitely a good argument, but you still have to get the right buyer that's willing to still cover that gap and say, yeah, I'm willing to buy it based on performance, because you're still not going to get lending based on performance. It's going to be few and far between as far as lenders, even our DSCR lenders, even the asset-based type lenders that are technically more commercial type loans. Yeah. They're looking at revenue that the property is generating, but they're still looking at average. They're not looking at individual property revenue. For example, if I have a really high performing property, they're not going to lend you more money on my property. They're going to look at the market average. And so it's still difficult, I think, to price properties that way. And where we see people trying to price it is about that 10% rule. It seems like, okay, if a property is generating $100,000, they're saying, okay, we're going to sell this for $1 million. It still has to be dang close to the property value, though. At the end of the day, it comes down to what the property is valued at and what it appraises for. ultimately it's got to be somewhere close to that. Or we see them falling flat if people are stretching too much.
Okay. And that makes total sense. Shawn, you brought up an interesting point that I want to come back to, and that's around revenue projections. I think most owners, short-term rental owners, would tell you that the last 2 years have been banner years for them. And so how do we square what has been with what will be, kind of given today's market?
Yeah, great question. So one of the things that I think that the reason it's been banner years is because occupancies have been so high, right? We've had 2 years of basically a never-ending summer, right? We haven't, seasonality's gone out the tube. It's been really high occupancy across the board. So we've been talking about, I talked about this, even at the very beginning of this year's kind of our projections is we're going to see occupancy in short-term rentals come back down to the normal seasonal type levels. When we underwrite our deals, I never underwrite based on that top percentage of occupancy. Like there are people that will say you can get 80, 90% occupancy in short-term rentals. We don't do that. I don't believe that that's a long-term. I mean, short-term rentals are short-term for a reason. Your occupancy is going to be somewhere 70 to 80% in some of the best markets. Where we've seen the last couple of years, some of those best markets are 80, 90% occupancy. That's not sustainable in the short-term rental game. If you have a short-term rental and you even try to have 90% occupancy for an entire year, it's really, really difficult because you have these odd days that are in between days anyways that throw that occupancy. It's just hard to do, right? And so you have to say, okay, look back. So when we underwrite back to 2019, 18, 17 levels with our occupancy. We look at that occupancy in those years when we're doing our underwriting. So that helps us bring that overall revenue down a bit. Now, the flip side of that is revenue numbers have been consistently going up. Revenue didn't spike. Average nightly rates didn't spike like occupancy did. So the overall gross revenue had this huge spike in these banner years, but it was driven by occupancy. Now, rates are a different story. Rates have been consistently going up, but they didn't have these big spikes. They've been, and what you will find in short-term rentals, which is interesting, is there's a gap in the market. You've got the bottom of the market, you got the middle of the market, you got the top of the market. And so when we underwrite these deals, we're very conservative on our occupancy. And then we want to look at the range. We want to look and say, okay, given occupancy on this area that we're underwriting, I want to look at the bottom of the market as far as average nightly rates. I want to look at the middle of the market for, 3-bedroom homes and the average nightly rates here. And then I want to look at the top of the market. That will give me a revenue range that we're looking at. Then what we want to do is say, okay, based on this property I'm looking at, where do I think it's going to fit in this market? If I'm in a beach market and I'm not on the beach, I'm probably not going to get that top revenue range because most of those top revenue properties are on the beach, for example. Mm-hmm. So I have to start to now make this logical analysis on this range of revenue. But you want the way that I know the original question is, how do we say, okay, the last 2 years have been an anomaly. It's an anomaly based on the occupancy for sure. And then you've got to start to look at those nightly rates and then take a more conservative approach back in 17, 18, 19 as far as occupancy. And that's how we underwrite the deals now, because we just don't think that occupancy is going to continue. Now, what we saw another spike in occupancy this summer, again, really high. We started to see kind of normal occupancy come in the spring, and then we just saw a big spike again this year, but I just don't think it's going to last. And so we take a very conservative approach as far as occupancy goes. Okay.
And that makes total sense. And Shawn, my last question for you is with regard to expenses. You mentioned in the kind of the long-term space, your PITI, your property management fee we could throw in there. And then in the short-term realm, we've got your cleaning expenses and the utilities. What else should people be expecting to have on their line item for expenses with a short-term rental?
Yeah. So your fixed expenses are really pretty similar, right? You got your PITI, you've got on your fixed expenses, what's going to be different than a long-term rental or other types of properties are going to be your utility costs, right? You're going to be paying internet, cable, your electrical, all that stuff that's going to be as part of your fixed expenses. So that's going to jump your expenses up. The variable expenses are what a lot of people miscalculate. And variable expenses, when you start to add in and these are based on the number of stays, and they're going to be based on the gross revenue. Your management company is going to take a percentage of your gross revenue. Your booking sites like Airbnb, VRBO, they're going to take a percentage of your gross revenue, right? So when you get a booking, they're going to take a percentage of that. Those fees are what's going to eat into your overall profits. And so a lot of times people are like, well, man, I'm making 3 or 4 times what I would make on a long-term rental, on a short-term rental, doing this nightly. But by the time you add in, 30% in management fees, all those different things start to add up. Now you're not making 3 or 4 times the profit typically. So the biggest expense that people mess up is the management. And I always tell people there's a couple approaches you can take with management. Even if you self-manage and you put your properties on Airbnb, VRBO, you're going to still run an average of about 8 to 15% of basically a management fee that's going to go to those booking sites where you're booking your property. If there's a hybrid approach where there's companies like Evolve and some of those companies that will do 10%, but they're going to be 10% plus that 8 or 10%, right, from the booking fee. So you're going to be a total of about 20% in management if you have that hybrid approach where you do some of it, they do some of it. If you go the full service route, which I suggest most people take that route, and it's going to be different than what most of the other coaches out there are ever going to tell you to do because it doesn't look good on the front end on the numbers, right? But I just believe most people are not set up to manage short-term rentals at a high level. You're better off getting a full service management company to help you. And that's going to cost you 30 to 35% of your gross revenue. That's a huge line item, right? That's a huge expense. And so you have to make sure, one, that you get the right fit because that they're going to be your largest expense. You want to make sure they're doing a good job. I always tell people a good management company is worth their weight in gold. A bad one is really a nightmare. So you want to make sure that you've got the right fit there. But that's a big expense that a lot of people don't think about. And I have on every one of my properties. I use full service management on every one of my properties for a reason, right? Because it's what makes these properties allow us to be passive investments. And I want something that is a passive investment. I'm not looking for another job to manage these properties. And so those are the biggest ones, the management, and then your fixed or your utility costs that you normally wouldn't have to pay for.
Okay. That's great. Shawn, this has been a ton of fun, man. I want to be very respectful of your time. If people want to learn more about you or more about Vodacy, where's the best way? How can they reach out?
Yeah, awesome. I appreciate that, Michael. So they can just go to Vodacy.com. It's VODYSSEY.com. You can go check out our stuff. I've got a book there. It's called What the Hell is a Lifestyle Asset? It's #1 bestseller on Amazon. So you can go check that out. It talks about our whole process, taking you through that acquisition phase, that setup and management phase, and ultimately the marketing phase. And then, we've got I've got our podcast on there. We've got a YouTube channel. We've got tons of free stuff that people can dive into if you just go to Vodacy.com and learn a little bit more about us and our view of the vacation rental world. And then, that's a great place to start right there.
Right on. Well, Shawn, thank you again for coming on and sharing some wisdom with our listeners. Really appreciate it. And I'm sure we'll chat soon.
Awesome. Thanks for having me, Michael.
Okay, everyone, that was our show. A big thank you to Shawn for coming on. Super eye-opening, really informative to learn about the vacation rental space from his perspective. As always, if you enjoyed the episode, please feel free to leave us a rating or a review, whatever it is you get your podcasts, and we look forward to seeing you on the next one. Happy investing.